Welcome. Today, we're going to dive into a really fascinating business case study. How one leader, Jamie Dimon, basically forged JPMorgan Chase into the absolute titan of global finance it is today. We're going to get into the key decisions, the hard numbers, and the one central question that really defines his entire tenure. So, yeah, let's jump in.
Okay, let's just start with the results because honestly, this chart says it all. Since Jamie Dimon took over as CEO back in '06, JP Morgan stock has delivered an absolutely staggering total return of over 1,100%. Now just look at the comparison. The broader bank index, which tracks the entire sector, has been, well, almost completely flat for that same period. I mean, that's not just outperformance, right? That is total, utter dominance.
And this dominance is built on a scale that's, well, it's almost hard to wrap your head around. The bank that Dimon runs holds over $4.5 trillion in assets. To put that into perspective for you, that's more than the entire economy of a country like Germany or the UK. It is, without a doubt, the undisputed king of the financial world. Which, of course, brings us to the big question of this whole explainer. How does something like this even happen? How did one person's leadership create such an absolute powerhouse? Well, this leads us to a concept that analysts have, and they call it the Dimon Premium. This idea that the market actually puts extra value on the company just because he's the one in charge.
So to really get what that premium is all about, we've got to look at how he leads when the pressure is at its absolute highest. So we're going to break down 3 really critical moments that define his crisis playbook.
All right, first up, let's rewind to the banking turmoil of 2023. Remember that? As panic was starting to spread and another bank, First Republic, was teetering on the edge of collapse, Dimon basically stepped into a role that felt less like a CEO and more like a government official. He became, for all intents and purposes, the industry's diplomat-in-chief. And his response? It was incredibly fast and decisive. First, he used his pretty unique influence to personally rally other major banks, getting them to inject $30 billion in deposits to try and save First Republic. But when even that wasn't enough, he took this second, much bolder step. He had JP Morgan acquire the failing bank outright, stopping the contagion dead in its tracks.
Now here's what's so interesting, and it's all in this quote. Dimon framed this move not just as a smart business deal for them, which, don't get me wrong, it was, since the FDIC covered most of the bad loans, but he framed it as a patriotic duty. With that one sentence, he cemented JP Morgan's image as the stable, reliable bank of last resort that the whole country could count on.
All right, let's jump to our second case. This one shows a completely different but just as important leadership principle. Back in 2012, the bank took a massive hit, a $6.2 billion trading loss from a trader they called the London Whale. Now, in an industry that's, let's be honest, pretty famous for pointing fingers, what Dimon did next was, well, pretty much unheard of. So he goes in front of the US Senate, and instead of dancing around it or making excuses, he just says this. He took full, unconditional responsibility. This idea, this radical accountability, it's like a cornerstone of his whole leadership style. There was no finger-pointing, no blaming some rogue trader. The buck, he said, stopped with him. And look, these weren't just empty words. He backed them up with immediate action. He voluntarily took a 50% pay cut, and, maybe most importantly, he completely overhauled the bank's internal risk controls. You know, by taking all that political heat himself, he managed to avoid what happened to so many other CEOs in similar spots. They got fired. This move arguably saved his job and let him lead for another decade. Okay, so our last case study. It's a little different. It's not about one single crisis. It's really about how Dimon just being there and the whole mystery around when he'll eventually leave has become this huge strategic asset all on its own. It's a source of incredible stability for the market. I mean, just look at this timeline. His time as CEO has covered multiple massive global events. And through all of that, there's this running joke on Wall Street that Jamie Dimon's retirement is always just 5 years away. That consistency, that feeling that there's no power struggle or uncertainty at the top, that's a really powerful stabilizing force for investors. Okay, so we've heard the stories, we've seen the playbook in action, but what about the numbers? How do you actually quantify this so-called Dimon Premium? Let's take a look at the hard data. First up, efficiency. The efficiency ratio basically tells you how much a bank has to spend to make $1 of revenue. So, yeah, lower is way, way better.
As you can see, JPMorgan is running at around 51%. Its competitors? They're stuck up in the mid-60s. Think about that. That's a huge operational advantage every single day. And it's probably driven by the incredible scale that comes with being a financial giant. All right, next, let's talk about pure profitability. This number here is the return on tangible common equity, or ROTCE. At 22%, this shows that JPMorgan isn't just a giant, it's an incredibly profitable one. This is a best-in-class number. It shows the bank's engine is just firing on all cylinders, turning its massive size into industry-leading profits. And this slide, man, this just pulls it all together perfectly. The story becomes so clear. Just look at the valuation. The market values JPMorgan at 2.4 times its tangible book value. That's basically its net worth. Meanwhile, a competitor like Citigroup is trading at just 0.6 times. That gap, supported by that better efficiency and higher profitability, that right there is the Dimon Premium, captured in the numbers. So this all leads us to the big dilemma, the core tension of this whole story. Is this premium a well-deserved reward for building an unbelievable financial fortress, or is it a dangerous dependence on the one and only person who designed it, the architect?
This gets at a classic business school idea you've probably heard of, key man risk. It's the danger a company faces when it becomes so reliant on one single person that if they leave, for whatever reason, it could seriously damage the business.
And look, we're not just talking theory here. Analysts have actually tried to put a dollar figure on this. The general consensus is that the day Jamie Dimon leaves, it could trigger an immediate 5 to 10% drop in JPMorgan stock price. That is literally the price tag the market has put on one person's leadership. So it all boils down to this, right? How do you look at this premium? Is it a fair reward for almost 2 decades of just exceptional performance and steady leadership through crises? Or is it a blinking red light, a warning sign that the world's most important bank might have a single point of failure? You know, for now, the market seems to have made up its mind. It's pricing the company like all that stability, all that crisis leadership, all that strategic vision, like it's a permanent part of the deal. But of course, no leader is forever. And so that leaves us with one final, really big question to think about. After being shaped by one of the most dominant CEOs of our time for 20 years, is the fortress he built now strong enough to stand on its own, without its architect?